Hello, everyone. I'm Bob Goulder, a contributing editor with Tax Notes. Welcome to the latest edition of In the Pages, where we take a closer look at some of the content from our print and online publications. Our featured article for June was written by Roxanne, a contributing editor with Tax Notes, who specializes in state and local issues. Viewers will recognize Roxanne because she writes the popular Salt Box column that appears regularly in the state edition of Tax Notes. Her article addresses the issue of NFTs, which of course stands for non-fungible tokens, which are all the rage these days. Out there in the world, there are people making fortunes buying and selling these things. Although to be perfectly honest, I still struggle to appreciate the full value proposition behind them. But hey, that's just me. Pay no attention to my personal skepticism. Fact is that in a short amount of time, NFTs have gone from the obscure backwaters of the global investment community to becoming relatively mainstream. So much so that the tax authorities are having to figure out what to do with them. Well, we're going to be discussing these tax angles, and Roxanne's article is an excellent starting point. And that article is titled New Taxable Kid on the Block, NFTs. And we're delighted to have the author join us. Roxanne, welcome to In the Pages.
Thank you, Bob. It's a pleasure to be here.
So for the benefit of any viewers who might not be familiar with NFTs, could you provide us with an example? Tell us what they are.
Well, as you mentioned, NFTs are non-fungible, which means they are not interchangeable. So a real world example of a non-fungible would be your house, your car, your furniture, something like that. What makes non-fungibles non-fungible? And I'm going to use Ethereum as an example because I think that's the biggest platform for minting NFTs. It's unique because it has an identifier that is linked to one Ethereum address, which no other token can replicate. So an NFT can only have one owner, and that uniqueness serves an important function because it is proof of ownership. Now, there's a whole list of things that proof of ownership means, but it's really just your private key. That's what most people will understand, just like with crypto. You have a private key to your wallet in order to access your crypto. It's the same thing with NFTs, same concept. So what can an NFT be? Well, it could be anything that can be represented in the digital world, as the real world. For example, art, music, videos, or a combination, collectibles like baseball cards. I didn't say cards. Or real world items like the deed to your house can be an NFT, your car registration, or other legal documents. So the importance of having, a real world item like that on an NFT is because it can't be counterfeited or tampered with. Well, at least for now, we don't know where technology is going. But like I said, it's the owner's private key that is the proof of ownership.
Now, your article mentions that smart contracts are involved here, and we're talking about the sales contract. If you have one and I want one, we don't just do it with a handshake or something like that, right?
Right.
Or scribble down a conventional contract in the normal everyday sense. Smart contracts are involved. Can you work through that?
Sure. A smart contract is really just a software app, and what it does, it's whenever you mint when you mint an NFT, it also generates a code that underlies it, and that's created whenever an NFT is minted. What a smart contract does is to verify ownership, and it handles the transferability of the NFT. Now, it can do all kinds of things, but that's basically what it does. It can do things like handle royalty payments, which otherwise you would have to have a person to do. It can just do it automatically. Other payments, just like, okay, I bought X, and once the app decides that all of the contract terms have been fulfilled, it executes itself. Done deal. So that's its, I think, its real advantage over, a paper contract. It can't be counterfeited, can't be tampered with, or anything like that. So, the people who enter into the contract are safe in the knowledge that this contract is what it says, and this is it. And if you want to put, of course, a writer or something like that, then you have to execute another NFT writer. But again, it's set in stone, so to speak. So that's a good thing about smart contracts.
Now, in your article, you compare what you get with the NFT to the bundle of ownership rights that you acquire when you go out, say, to an art gallery and buy a work of art. And what we mean by that is you get the item itself. You don't necessarily get the intellectual property behind it. Just as an example, if I'm walking down the street in New York City and I go into an art dealer and I buy Andy Warhol lithograph, I own that lithograph. I don't own the intellectual property. I don't own the copyright on the Campbell soup can, so I can't go out and license it and so forth, unless everyone decides that that's part of the NFT. Now, how does that play out with NFTs? That you have the token, but not necessarily anything more.
Actually, it's the same way. It's the same thing. You buy a token, and let's just say you buy a token. You have the right to display it, but you can't make any derivative works of it. You can't license it to anybody else. So it's just like buying a painting from an art gallery. Now the NFT seller can give you licensing licensing rights that vary the gamut. You can reproduce and sell these things for yourself, as long as you own the NFT and as long as you're doing it for yourself. And usually those contracts come with a stipulation that you can't make more than X dollars a year off of what you're doing. But it also doesn't give you the kind of commercial license. Like you can't license the piece to a third party, like a movie theater or something like that. But otherwise, it's pretty much like buying a real world art item.
All right. Now, there's all sorts of tax implications here. So we know that inside the Treasury Department building, there's some very smart people scratching their heads trying to figure out what to do about this. They haven't, as far as I know, haven't issued anything specifically for NFTs. But your article does mention an IRS notice that's already several years old now, but it just relates to cryptocurrency, right?
Right. Correct. As you say, the IRS has issued nothing, but I think considering what they have done with crypto, that it is property for tax purposes, I think it's almost a foregone conclusion that they are going to do the same. They would do the same with NFTs, because NFTs are even more property-like than crypto. So I say almost foregone because it's my personal policy not to say anything definitive, because that way, if I don't, then that way I'm never wrong.
Okay, so let's run through some permutations here. If assuming that an NFT is going to be property, and you don't want to say that, but I'm going to say that, hypothetical, let's say we can say it's property. How are the states going to deal with that? Because aren't there implications for something just as basic as the retail sales tax?
Yes, there are, very much so. I want to add too that the states have issued, as far as I know, the states have issued no guidance on how to treat NFTs. But if a state has a statute on the books that deals with digital products, it is no-brainer to put an NFT into that statute. Okay, so no amendments necessary. It will be subject to sales tax, and the tax will be collected just like any other tax. The seller will collect and remit to the state. Now that's intrastate. That's interesting. We're going to just concentrate on intrastate right now. If a state doesn't have as broad a statute, then they may have to enact a statutory change. But that I can't imagine that would be all that difficult, to make NFTs taxable, specifically taxable in a state.
All right, so let's see, there's 50 states plus the District of Columbia, but not all of them have sales taxes. What are there, 45, 46 sales tax jurisdictions?
I think it's 45 states, not counting the District
not counting the Columbia. Okay,
but
so
45 states are sales tax states.
All right, so they already have a sales tax system on the books, and we're thinking they probably don't have to enact any statutory amendment. They can just fit NFTs into the pre-existing definition of property. Some of these things, Roxanne, go for a lot of money, a whole lot of money. It makes your jaw drop what these things are being bought and sold for. So are people really collecting and remitting? Because that's a lot of tax.
Well, that's a really good question. And it's a good question because there are, are we still talking about intrastate sales?
Yeah, just intrastate.
Well, then if they are selling NFTs even for exorbitant sums of money, then they should be collecting sales tax.
Yeah.
I don't have any information of whether that tax.
Yeah, it's too early. We don't have any data on how much revenue, if any, is being collected. Now, what about the concept of a taxable event? Because I'm no expert in the area of consumption taxes at the state level, but there does have to be a taxable event. And the easiest thing is to just think it's the sale. But you explained this in the article very nicely. Some NFTs are structured so that there's a redemption. It's sometimes subsequent to the point of acquisition. Is there a possibility that maybe the sale isn't the taxable event, but it's the subsequent triggering event or redemption of the token?
Well, a sale is always a sale. If a NFT dealer sells something, the NFT dealer should collect the tax at the time of the sale. And the redemption doesn't really matter. That's secondary. The redemption is the actual transfer of ownership in the real world. Now, something else I tried to explain in the article, it might be for this purpose. It might be easier in some cases to collect the tax on redemption because there are people who are not going to redeem, whatever it is they bought. But if they're in a sales tax state and they purchase the NFT and the state sales tax statute tax NFTs, then it doesn't matter if they redeem or not. They're going to pay sales tax.
Now, we've discussed the intrastate scenario. Let's shift gears here and look at the interstate. If you're in California and I'm in New York and you're selling me an NFT, what then, especially in the aftermath of Wayfair?
Well, that's a really interesting question. The sales tax state, I think every state now, sales tax state, has enacted a South Dakota-like, statute. And if you have a big dealer, okay, that meets the money, the monetary threshold as well as the transactional threshold, then they're going to collect and remit. Smaller dealers, you would think that they would fall under the threshold, and they would, except, Wayfair is kind of strange in that it leaves a lot of unanswered questions. The court talked in terms of you have to have an economic presence as well as a virtual presence. But what if you don't? What if that big company, has an economic presence because they made X dollars of sales, but they don't, advertise. They're not really on the net or something like that. Well, if they don't have a virtual presence, how does that work? Is the nexus, that the state's nexus statute, still valid? That's a case that's currently in the petition stage at the U.S. Supreme Court. What exactly does economic presence and virtual presence mean? Do you have to have both, or is one enough? Because, the reason why, it's, kind of wishy-washy, or whatever the correct term is because in Wayfair, the court was dealing with 3 huge retailers that certainly had the economic and the virtual presence, in every state. So there was really no need for it to go beyond that. We wish it had, but it didn't. So these are more questions that are going to have to be, litigated. And this one case, it's called UMA, lovely. It is the first case that I know of that has made it to the U.S. Supreme Court. I do hope they take it, because I think there are some clarifications they need to make with respect to Wayfair.
Now, your article compares the situation we have today with NFTs to the situation we had a few years ago with our old friend VoIP. Remember VoIP, VoIP, Voice over Internet Protocol, which was fascinating because, there's authorization to tax phone lines, and then they want to tax a phone call that's made over the internet, but it's technically not a phone line. Could you elaborate on that whole comparison and how it might influence our thinking about the taxation of NFTs?
Well, I think what states did is, until VoIP came along, everything went over wires. And I think what the states did was like, well, this is a telephone call. I mean, it has the same function as a telephone call that works with wires. So, it really wasn't unreasonable for the state to say, this serves the same function, so we're going to tax it like a wired telephone call. And I don't recall if there was any real pushback from the VoIP providers over that, because it's the functional equivalent, and it's hard to argue with that.
Now let's talk just a little bit about capital gains. We mentioned consumption taxes before, but this is an income tax question. You buy low, you sell high, you make your money, the American dream and all that. What are the implications there for federal and state tax authorities? Are these going to be capital assets, you think? If we assume that they're property, is it a stretch to say that they're a capital asset?
It could be. It depends on what you do with it. It's the intent behind the purchase. I mean, are you just buying it to put on your virtual wall, or are you actually buying it to serve a purpose in your business or whatever? Or if it's personal, are you treating it as an investment? I mean, I think these are questions, these are certainly questions that are going to arise, but I think first we have to figure out if it's property. I mean, we need to get that on the books, and then we can go forward. Like, with crypto, okay, it's property, you have capital gains. Well, it's conceivable that NFTs are going to be treated the same way, but we don't know. Mm-hmm. Again, almost foregone conclusion. So, until there's guidance out there, people are just kind of doing what they're doing.
Well, that's interesting because, if I go and I buy a share of stock in General Electric, my broker is going to know the date that I acquired it and the price I paid. And that matters in terms of your basis. You start with cost basis and you work toward
Mhm,
adjusted basis, and
mhm,
you separate it from the amount received when you sell it. So you can calculate the capital gain and or loss. You do that on a worksheet, and then it carries over to your 1040, your annual federal income tax return.
mhm.
I just wonder what's going on out there now, whether it's the Wild West or is the IRS scrutinizing and enforcing this, because people are, as we speak, buying and selling NFTs, sometimes for many, many millions of
Right.
dollars. And well, it just seems to me, if you go to the definition of income in section 61, the Internal Revenue Code, income from all sources derived, it's not going to
Mhm.
exclude buying and selling NFTs. But as you said several times, it sure would be helpful if the federal government issued some kind of guidance here.
Well, the other thing about buying and selling NFTs for whatever purpose, um, the you mentioned the basis. What's your basis in the NFT? Well, that's going to be recorded on the blockchain.
Right.
All of that information is going to be there, and it's going to be transparent.
Now,
So, meaning, anybody can go look at it. So you're going to have your basis no matter what. And then, you sell for more, you get, a gain. And if you sell for less, you get a loss. And, if assuming that NFTs are going to be treated as property, then it would be no different, than the way they treat crypto. The IRS treats crypto.
well, there you have it. The lay of the land in terms of state and federal taxation of non-fungible tokens. So many unanswered questions. We think it's property, but we're not quite sure. We think it's probably going to be a capital asset, but hey, maybe not. You got to look at the definition of capital asset. So an area that is going to change and evolve in the years ahead. We know that the folks in the government are thinking about this, and we hope that it's sooner rather than later that they issue some guidance so people will know how to proceed. There's a world full of taxpayers out there, and most of them hopefully are trying to do the right thing and comply. So it would be nice if we gave them some more guidance on that. I highly recommend the article. Again, the author, Roxanne Bland, and the article is called New Taxable Kid on the Block, NFTs. You can find it in the state edition of Tax Notes. Roxanne, thank you for coming on our program and being our guest.
Thank you for asking me, Bob. I appreciate it.
Until next time, bye-bye.
Want more like this? Subscribe for more tax videos. Special thanks to our executive producers, Jasper Smith and Paige Jones, and showrunner and video editor, Jordan Parrish.